Welcome to the Byte-Size Brief. Today we are putting intuitive machines, that's LUNR, completely under the microscope. Let's get into it.
Yeah, I mean, the sheer volume of data surrounding this company right now is it's unprecedented. We are really looking at a complete paradigm shift in how the aerospace industry is valued.
Exactly. Imagine spending $100 million to send a highly engineered spacecraft to the moon, right?
Right.
Only for it to, trip over its own feet and land completely on its side in the lunar dust. In the Apollo era, that is a career-ending catastrophe.
Oh, absolutely. Heads would roll.
But today, the stock market cheers, and the underlying company secures hundreds of millions in new defense contracts. It's wild.
It is wild, but it's also a fascinating contrast. You see the extreme optimism of retail investors colliding directly with the hard, cold operational metrics of a capital-intensive aerospace company.
Which is exactly why we are doing this. And to make sure you are getting the full picture, we have pulled together a stack of incredibly fresh sources. We are digesting their Q4 2025 earnings call, transcripts, aerospace industry reports from Payload Space and the Chronicle Journal.
Plus some really deep financial analyses from Guru Focus and XTB.
Right, and to top it all off, we are diving deep into the raw retail sentiment from Reddit forums. We are going to cut through the absolute hype of the commercial space race and figure out if LUNR's fundamentals actually support the massive ambitions currently driving its stock price.
Because, the goals are astronomical, literally, but the balance sheet is what actually keeps the lights on.
Exactly. So to understand where LUNR is going in 2026, we first have to look at the exact financial reality they just reported for the end of 2025. Okay, so compared to last quarter, what actually moved the needle here?
Well, the Q4 2025 numbers require some serious unpacking.
Lay it on me.
So revenue came in at $44.8 million. And if you zoom out to the full year 2025 revenue, it actually dropped. It went down 7.9% year over year, down to $210.1 million.
Ouch.
Yeah. The company also posted an operating loss of $33.1 million for the quarter. And over the entire year, they burned through $56 million in free cash flow.
Wait. $56 million just burnt.
Yeah, negative free cash flow.
See, a drop in annual revenue and a $56 million cash burn. If you are reading that on a standard earnings screener, that immediately sounds like a company going in the totally wrong direction.
I mean, on paper, it does look bad.
So the obvious question is, why the significant revenue miss? Like, what actually went wrong?
Well, the data shows this actually wasn't an execution failure on the engineering side at all.
Wait, really?
Yeah. The primary culprit was the mechanics of U.S. government funding. Specifically, the heavy reliance on continuing resolutions, or CRs, by Congress.
Ah, the dreaded CRs.
Exactly. When Congress fails to pass a formal budget, they use a CR to keep the government open. But they do it at the previous year's funding levels.
So basically, it's kind of like your boss telling you that your promised raise is approved, but human resources frozen, so you have to keep working on your old salary until they sort out the paperwork.
That captures the frustration perfectly. By law, during a continuing resolution, government agencies like NASA and the Department of Defense are barred from starting new programs.
Or increasing their spending rates, right?
Right. So contractors like LUNR, who are actively hitting their development milestones, they just cannot get the cash dispersed.
Even for work that is already completed.
Yep, completed or ready to be awarded. The funds are just totally gridlocked in Washington.
That is so frustrating for a growing company. However, looking through these Q4 earnings, there's a very interesting detail hiding beneath that top-line revenue miss. Their Q4 gross margin hit a surprisingly positive 19%, which equates to about $8.5 million.
It did.
How does a company expand its profit margins when its primary customer is legally barred from paying them on time? Like, how does that math work?
They achieved that by heavily restructuring their internal cost efficiency, and it was really aided by their recent Kinex acquisition. Let's break down the mechanics.
Okay, let's do it.
So LUNR operates largely on fixed-price contracts. The government pays a set amount, say $100 million, regardless of how much it costs the company to actually build and fly the hardware.
Meaning every single dollar they save on development goes straight to the bottom line.
Exactly the dynamic at play here. Deep space navigation requires constantly calculating orbital mechanics, thrust vectors, gravitational pulls.
Super complex stuff.
Incredibly complex.
Yeah.
Historically, LUNR had to pay external specialists a huge premium to plot those trajectories. But by acquiring Kinex, they brought that proprietary space navigation software completely in-house.
Oh, I see. And software scales infinitely without the heavy marginal costs of physical hardware.
Exactly. By replacing expensive outsourced contracts with their own internal software, they squeezed far more profit out of the limited revenue they actually did recognize.
That is a brilliant operational pivot.
Mm,
But I have to bring us back to the capital expenditure reality for a second.
Sure.
A $56 million cash burn is still a massive red flag for any portfolio. Building physical space infrastructure requires purchasing titanium, hiring specialized aerospace engineers, and securing supply chains long before a rocket ever reaches the launch pad. Is that burn rate just too dangerous for an everyday investor to stomach?
Well, context is everything when evaluating aerospace balance sheets. The market actually expects aggressive cash burn at this stage of infrastructure development.
They do.
Yeah, investors are not looking for immediate dividends here. They're looking for a clear path to sustainable, recurring revenue. And that points directly to why LUNR made their next massive strategic move.
Right, because to survive the unreliability of government appropriations we just discussed, they clearly realized they needed predictable cash flow. Which brings us to the Q1 2026 acquisition of Lanteris Space Systems.
A huge deal.
This completely alters the DNA of the company.
It really does. It transitions them from a niche lunar lander company into a broad space infrastructure contractor. They closed the Lanteris deal for around $800 million.
Whoa, $800 million.
Yeah, and to understand the scale of this, you have to look at the backlog metric. Backlog is essentially guaranteed future revenue from signed contracts, right?
Right.
Standalone LUN had a backlog of $213.1 million. With the Lanteris acquisition integrated, the newly combined company boasts a staggering $943 million backlog.
Wait, $943 million as of February 2026.
As of February.
They literally quadrupled their guaranteed future work in a single quarter.
They did.
But what specifically did they purchase to secure that kind of defense-backed revenue? Like, what are they actually making?
They purchased the manufacturing capacity for national security contracts. Lanteris is actually contracted to manufacture 18 satellites for L3 Harris Technologies.
Okay, 18 satellites. For what exactly?
This is part of the Space Development Agency's proliferated warfighter space architecture, specifically the Tranche 3 tracking layer.
Okay, let's demystify that architecture for a second.
Yep.
For decades, the U.S. military relied on a handful of school bus-sized, multi-billion-dollar satellites. Right.
Huge, expensive target.
Exactly. If an adversary takes out just one of those, you lose a massive chunk of global communication or missile tracking.
Which is exactly why the Pentagon shifted to a proliferated approach. Instead of 5 giant targets, they're putting hundreds of smaller, cheaper satellites into low Earth orbit to act as a resilient mesh network.
That makes total sense.
Yeah, and L3 Harris is a prime contractor for this network, and they need reliable assembly lines to churn out the hardware. Lanteris provides that assembly line.
Which gives LUNR consistent, defense budget-backed revenue that is just much less susceptible to the political gridlock of NASA science missions.
Spot on.
And this acquisition is the primary catalyst behind their insane 2026 revenue guidance. They are projecting $900 million to $1 billion in revenue for 2026, alongside positive adjusted EBITDA.
Moving from $210 million to $1 billion in a single year is a fundamental re-rating of the entire business. However,
There's always a however.
executing an $800 million acquisition leaves a massive mark on the balance sheet. LUNR spent $450 million cash on Lanteris and had to raise an additional $175 million in capital.
Hold on, how does that actually affect LUNR's stock price for regular investors like me? Are we looking at heavy dilution risks?
It's a valid concern. When a company issues new shares to raise capital, it shrinks the ownership slice of existing shareholders.
Exactly. So after all the dust settled in February, they were left with $272 million in cash. The critical question here is, does that $272 million give them enough runway to execute this billion-dollar sprint without needing to dilute shareholders again in 6 months?
The financial data offers strong reassurance here, actually.
Really? How so?
Despite the heavy acquisition cost, LUNR still holds more cash than debt.
Oh, wow.
Yeah. Maintaining a net positive cash position while actively scaling manufacturing is a rarity in the aerospace sector. This suggests they acquired a cash-flowing asset rather than a money pit, which significantly mitigates the immediate risk of toxic dilution.
That is a huge relief. Now, with the Earth orbit satellite assembly line securing the balance sheet, the conversation naturally shifts back to their core identity, because April 2026 has just been totally defined by the moon.
It has.
The stock surged 17% intraday in early April.
That price action was driven by 2 intersecting events. First, the massive success of the Artemis II launch by NASA, which safely sent astronauts around the moon, totally reigniting public and institutional interest in lunar exploration.
It's like the space race all over again.
Exactly. And second, NASA awarded LUNR a brand new $180.4 million commercial lunar payload services contract. That's the CLPS program, specifically for the IM-5 mission.
And IM-5 requires a complete evolution of their physical engineering. They're retiring the Nova C landers used for the IM-1 and IM-2 missions, right?
Right. IM-5 will utilize the new Nova-D heavy cargo lander, and scaling up spacecraft is not a linear process at all.
I can imagine. When you move from a 1,500-kilogram vehicle to a heavy cargo platform, the physics become incredibly unforgiving.
The engineering challenge shifts dramatically. It is no longer just about generating enough thrust to escape gravity. It is about managing the center of mass.
Right.
A heavy cargo lander carrying industrial-scale equipment has a high, awkward center of gravity. You are essentially trying to land a 2-story warehouse on an uneven, dust-covered crater, relying entirely on autonomous thrusters reacting in milliseconds.
Which makes NASA's confidence in them fascinating, considering the very public physical struggles of the earlier missions. Like, the imagery of the IM-2 lander tipped over on its side at the lunar South Pole was everywhere.
Yeah, it was all over the news. But the visual of the tipped lander kind of obscures the actual engineering victory.
Engineering victory fell over.
I know. But even resting on its side, the IM-2 lander actually functioned.
Wait, really?
Yeah. It successfully deployed the NASA Prime 1 drill. The drill extended, penetrated the lunar surface, extracted the target soil samples, and the lander transmitted that critical telemetry back to Earth.
That is actually insane.
It is. It proved the resilience of their systems under catastrophic physical failure. And that resilience is part of a broader momentum shift. Like, the entire space sector is experiencing a massive surge in capital right now. We are seeing reports of Rocket Lab's neutron rocket backlog accelerating and rumors everywhere about SpaceX filing a confidential $1.75 trillion IPO.
Right. But what does all that actually mean for LUNR investors?
Good question. It means the infrastructure they are building is about to become indispensable. If SpaceX and Rocket Lab are dramatically lowering the cost of reaching orbit, we are going to see a corresponding explosion in lunar traffic. Dozens of commercial and international missions will be heading to the moon in the next decade.
And all of those missions require one fundamental resource: communication.
Exactly. Which brings us to LUNR's Near Space Network, or NSN. Starting with the upcoming IM-3 mission, they will deploy dedicated data relay satellites into lunar orbit before the lander even touches down.
Let's explain why this is so critical. Currently, deep space missions rely on NASA's Deep Space Network, which uses massive ground-based radio antennas on Earth built back in the 1960s. That network is severely overbooked.
Highly overbooked.
Plus, dealing with the inverse square law of signal degradation means trying to beam high-bandwidth data straight from the lunar surface to Earth is just incredibly inefficient.
LUNR is stepping in to solve that bottleneck. By placing relay satellites in lunar orbit, surface rovers and landers only have to transmit their data a few hundred miles up to the satellite, which then uses high-powered lasers or advanced radio frequency to blast the data back to Earth.
They're basically positioning themselves to become the primary internet service provider for cislunar space.
That's a great way to put it.
They're building the toll roads and the cell towers of the moon. They will be able to charge other companies and even other sovereign nations by the gigabyte for secure data transfers and 4K video streams.
Which is incredibly lucrative.
Right. With billions in potential defense revenue from Lanteris and the foundation of a lunar telecom monopoly, it makes total sense why retail investors are aggressively mapping out astronomical share prices. But let's test their math against the hard realities of the sector.
Oh, we definitely need to. The sentiment on the Reddit forums is particularly aggressive right now. Retail investors are charting a path for LUNR to hit anywhere from $50 to $125 a share by the end of 2026.
Okay, so the methodology they're using relies heavily on the price to sales, or PS multiple. They look at peers in the sector, right?
Mm-hmm.
So, for instance, during periods of high growth, companies like Rocket Lab have traded at a multiple of, 20 to 30 times their revenue.
Which is a very optimistic multiple for hardware.
Right. But the retail thesis assumes that if LUNR hits that top-end $1 billion revenue mark this year...
That's a big if.
A huge if. But if they do, and you apply a conservative PS multiple of 20, you arrive at a $20 billion market capitalization.
Right.
Divide that by their outstanding shares, and you were sitting well over $50 a share.
The arithmetic functions, sure. But applying software-level valuation multiples to an aerospace hardware company carries profound risks. The market rarely prices space infrastructure with that level of optimism because, well, execution in a vacuum is rarely flawless. Let's examine the immediate hurdles.
Let's do it.
First up, the highly anticipated Lunar Terrain Vehicle contract, the LTV.
This is the development of the unpressurized rover. Essentially the moon buggy for the Artemis astronauts,
The
right?
LUNR is a top contender for that contract, which represents hundreds of millions in recurring annual revenue. Retail models are already pricing that in. However, NASA has delayed the award decision for 5 months now.
5 months.
Yeah. The revenue is entirely hypothetical until the ink is dry. Second, we must evaluate the upcoming IM-3 mission. The data relay satellite is theoretically game-changing, but the physical lander still has to actually navigate the descent.
And they face severe altimeter and sensor issues during the previous descents.
Exactly. The lunar environment is incredibly hostile to optical navigation. During IM-2, the thruster plumes kicked up highly abrasive lunar dust, which scattered the lasers on their altimeters, corrupting the altitude readings.
Oh, wow. So the lander couldn't tell how far away the ground was.
Basically. Furthermore, the extreme low sun angle at the lunar south pole created deep, pitch-black shadows that effectively blinded their optical terrain sensors.
Management claims they have engineered solutions for IM-3 by adding redundant, lighting-independent sensors like radar. But your point remains. Space hardware carries catastrophic failure risk.
It really does.
A software company pushes a bad line of code, they just issue a patch the next morning. But if a sensor fails at 5,000 feet above the lunar surface, the hardware becomes a permanent crater. Retail investors seem to be completely ignoring that fundamental CapEx risk profile.
While the physical risk is undeniable, the sources indicate a really fascinating psychological shift occurring among institutional investors right now. The market is actually becoming far more tolerant of physical hardware anomalies, provided the data integrity remains intact.
That feels completely counterintuitive. You would assume a tipped-over lander would trigger a massive sell-off.
Under the old paradigm, it absolutely would have. But investors are realizing that in the modern space economy, the physical orientation of the vehicle is secondary to the successful transmission of the payload data. Going back to the IM-2 mission, the vehicle was compromised, but the Prime 1 drill functioned, and the data flowed. The market prices the data, not the paint job.
So basically, as long as the Wi-Fi router successfully connects to the network and transmits the requested files, the market no longer cares if the router itself is bolted to the ceiling or sitting upside down on the floor.
That is a highly accurate assessment of the current sector maturity. We are transitioning out of the experimental can we achieve flight phase and fully entering the industrial did the contracted data arrive phase.
Wow. Let's synthesize everything we've uncovered today. The data shows that LUNR is rapidly shedding its identity as a scrappy, high-risk startup trying to touch the moon. Through the $800 million Lanteris acquisition, they have secured the national defense satellite contracts necessary to stabilize their balance sheet. Concurrently, by building out the near space network, they are positioning themselves as foundational infrastructure for the new space economy.
They are establishing the necessary prerequisites for a broader lunar economy. And considering the macroeconomic landscape, there is a massive geopolitical catalyst we cannot ignore. Our sources highlight that China has recently allocated a staggering $6.6 trillion budget for the development of their own lunar base.
$6.6 trillion. That is a multi-trillion-dollar commitment that fundamentally alters the timeline. That creates a total Sputnik moment pressure cooker for Washington.
It does. When the U.S. government feels its dominance in a strategic domain is threatened, they stop optimizing for cost efficiency and begin optimizing for absolute speed. Traditional prime contractors operate way too slowly to meet an accelerated timeline.
Right. This raises a really provocative scenario. If geopolitical pressure forces NASA and the Department of Defense to drastically accelerate their lunar architecture, a company like LUNR could transition from merely bidding on government contracts to actively dictating the terms, timelines, and pricing of the entire cislunar supply chain.
Because when you operate the assembly line for military satellites in low Earth orbit, and you own the only high-speed data network around the moon, you basically have the leverage to set the roaming charges for the next era of human exploration. That is an incredibly powerful position to hold.
It really is.
All right, listeners, what's your take on the future of LUNR? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.